There's a company you've never voted for, yet it can shake your pension, your mortgage, your job, even your government, without you ever seeing its name on a ballot. It quietly controls more money than almost every country on Earth. It owns big chunks of Apple, Microsoft, Amazon, Tesla, oil giants, banks, your local utilities. And it helps decide who runs those companies, what they invest in, and how much risk they take. That company is not a government. It's not a central bank. It's an asset manager. Its name is BlackRock. And today, BlackRock oversees more than $10 trillion of other people's money. Only the United States and China have bigger economies than the money this one company manages. But that's just the part you can see. In the background, BlackRock's internal AI-driven system called Aladdin watches over tens of trillions more for other institutions. A kind of financial operating system for Wall Street, pension funds, insurers, and even governments. So when markets panic, when governments face crisis, when central banks decide whether to pull the biggest levers in the global economy, they call BlackRock. And in this episode of Billionaire Money Stories, we're going to follow the money. From an almost forgotten mistake in the 1980s to a secretive piece of software that became finance's central nervous system, to the moment the Federal Reserve and other central banks handed BlackRock a blank check to help manage entire markets. Watch to the very end, because we're going to answer one uncomfortable question. If a single private company is now more powerful than most countries, what happens if it ever gets this wrong? Let's start with a phone call in the middle of a crisis. Imagine this. It's 2008, New York, Washington, London. The world's financial system is on fire. Bear Stearns has just collapsed. Lehman Brothers is wobbling. Mortgage bonds, the complex securities at the heart of the crisis, are imploding. Banks don't trust each other. Nobody is sure what anything is worth. Inside the Federal Reserve Bank of New York, officials are staring at screens filled with red numbers. They have to make a decision. Do we let parts of Wall Street burn to the ground? Or do we step in and buy up hundreds of billions of dollars of toxic assets nobody else wants? There's just one problem. The Fed and Treasury don't actually know how bad those assets are or what they're worth. So they pick up the phone, not to a bank, not to a government agency, but to a private firm in Manhattan that most normal people have never heard of, BlackRock. The Fed creates special maiden lane entities to hold mountains of bad assets from Bear Stearns and AIG, and it gives BlackRock a no-bid contract to manage them. Think about that. In one of the most important financial decisions in modern history, the U.S. central bank turns to a private company for help. And that company gets a front row seat to exactly what's inside the most toxic parts of Wall Street. This was the moment BlackRock stopped being just another asset manager and started becoming something closer to a shadow power in the global financial system. But to really understand how we got here, we need to rewind, because BlackRock was born out of a failure. Go back to the early 1980s. A young bond trader named Larry Fink is on his way up at a prestigious Wall Street firm called First Boston. He's one of the pioneers of mortgage-backed securities, turning home loans into bonds that can be sold to investors. For a while, he's a star. His division is making huge profits. He's on the management committee. He's the guy everyone wants to be. And then, interest rates move in a way he didn't expect. In 1986, one bad call costs his firm around $100 million. In Wall Street terms, that's the kind of mistake you don't walk away from. Fink is humiliated. His career at First Boston is effectively over. Most people would try to move on quietly and hope nobody remembers. Larry Fink does something different. He becomes obsessed with risk. He thinks, what if you could build a system that never lets you get surprised like that again? What if you could measure every position, every scenario in real time and see the danger coming before it hits you? That idea will eventually become the heart of BlackRock. In 1988, under the umbrella of private equity giant Blackstone, Fink and a small team start a new firm. They call it Blackstone Financial Management at first, then spin it out and rename it BlackRock in the early 1990s. Their goal sounds simple: manage other people's money, but do it with unmatched risk control. From day one, BlackRock is different. They don't want to be the flashiest traders. They want to be the best risk managers in the world. And that obsession leads them to build a tool that will change everything. Inside BlackRock's offices in the 1990s, a small group of quants and programmers are working on a project. It's not a new mutual fund. It's not a trading strategy. It's software. A system that sucks in data from markets, runs complex models, simulates thousands of what-if scenarios, and spits out a simple answer. How much risk are we really taking? They call it Aladdin. The name sounds magical, but it's actually an acronym: Asset, Liability, Debt, and Derivative Investment Network. At first, Aladdin is just for BlackRock's own portfolios. It tells them how their bond funds behave if interest rates jump, if a company defaults, if a crisis hits. But gradually, BlackRock realizes something. If they need this kind of tool, so does everyone else. By the early 2000s, BlackRock starts offering Aladdin to outside clients, other asset managers, banks, insurance companies, even big corporations. They don't just manage money anymore. They sell them brain that manages money. Fast forward to today, and Aladdin has grown into something enormous. Estimates suggest it is monitoring tens of trillions of dollars in assets. Not just BlackRock's money, but the portfolios of other huge institutions that rent its software. Think about the leverage in that. If you control the system that tells investors what they own, what it's worth, and how risky it is, you don't just move money, you shape decisions. And then, in 2008, the rest of the world finds out just how valuable that system really is. We're back in the crisis. Mortgage markets are melting down. Nobody trusts the prices on their screens. If you're the Federal Reserve or the US Treasury, you have two terrifying questions. 1. How bad is this really? 2. What happens if we pull this lever? Or that one? BlackRock has something almost nobody else has. Detailed models of mortgage-backed securities. Real-time analytics on portfolios across Wall Street. A team that lives and breathes risk. The Fed and Treasury bring them in as advisors. Aladdin becomes one of the main tools for valuing toxic assets and stress testing portfolios. BlackRock helps manage huge pools of bad mortgage securities through the maiden lane vehicles. It helps unwind positions from AIG and Bear Stearns. It helps figure out which assets should be sold and which should be held until markets stabilize. For BlackRock, this is a turning point. They're not just another firm trying to survive the crisis. They're on the inside of the rescue. and central bankers notice. In the years after 2008, BlackRock emerges as the world's largest asset manager. In 2009, it buys Barclays Global Investors, including the massive iShares ETF business, and its assets explode. Now they don't just manage bond funds, they manage index funds and ETFs that give everyday investors exposure to entire markets. If you own a simple S&P 500 ETF in your retirement account, odds are decent you're a BlackRock client, whether you realize it or not. And then, in 2020, another crisis hits. It's March 2020. The world shuts down. Airports empty. Offices close. Streets go quiet. Markets crash. Corporate bond markets, the way companies borrow money, start to freeze. Investors rush for the exits. Bond ETFs trade at strange discounts. The system is creaking again. Once more, the U.S. Federal Reserve faces a nightmare choice. Let the corporate bond market seize up, or step in with massive buying programs. And once more, when it needs help running those programs, it calls BlackRock. The Fed hires BlackRock to manage facilities that will buy hundreds of billions of dollars in corporate bonds and bond ETFs on behalf of the U.S. government. Let that sink in. The same firm that creates many of the bond ETFs now being bought is also hired to help execute the buying. BlackRock says it will waive certain fees and avoid conflicts of interest. Regulators sign off. But critics point out the obvious. A private company has now been put in charge of rescuing markets that it dominates. And it's not just the US. The Bank of Canada, the European Central Bank, the Swedish Central Bank, all at various points lean on BlackRock for advice or help structuring their programs. At this point, BlackRock is playing three roles at once: giant investor in global markets, provider of the risk software other investors rely on, advisor and contractor to central banks and governments. That combination is what makes BlackRock more powerful than many countries. But how exactly does that power show up in your life? Let's pull the camera back. BlackRock today holds stakes in thousands of companies around the world. It's a top shareholder in many of the largest firms in the US stock market, from tech to oil, from banks to consumer giants. When you buy a simple index fund, you're pooling your savings with millions of other people. And BlackRock, as the manager of that fund, gets to vote your shares in corporate elections. That means when there's a vote on who should sit on the board of a major oil company, whether a tech giant should change its executive pay, whether a bank should tighten its climate policies, BlackRock's decision matters a lot. For years, critics accused it of being too passive, just voting with management by default. Then it started talking more about climate and ESG, pushing some companies to disclose more, plan for net zero, and consider long-term risks. Conservatives attacked it for being woke and anti-fossil fuel. Progressives said it wasn't going nearly far enough. In response, BlackRock rolled out a voting choice program, letting some big institutional clients direct their own votes instead of letting BlackRock do it automatically. But here's the key point for you. Even if you never think about BlackRock, your retirement account probably does. Your mortgage rate is affected by markets it helps shape. Your job at a company it owns a slice of might depend on decisions it quietly votes on at shareholder meetings. And this power isn't just about stocks. BlackRock is increasingly big in bonds, deciding which companies and governments get cheap financing. In infrastructure, investing in airports, energy pipelines, data centers, and more. In real estate, buying stakes in housing companies, logistics centers, commercial properties. When money is this concentrated, the choices of a few executives in New York can ripple into rents in Texas, energy prices in Europe, or job growth in Asia. So is BlackRock evil? That's where the story gets complicated. On paper, BlackRock is just an agent. It doesn't own most of that $10+ trillion of assets. Its clients do. Pension funds, insurance companies, sovereign wealth funds, everyday investors. BlackRock's legal obligation, its fiduciary duty, is to serve those
clients, manage their money, and try to give them good risk-adjusted returns. Larry Fink likes to say, "We're not the environmental police. We're not the social police. We're here to help people retire." From BlackRock's point of view, their size is a byproduct of doing a good job. Low fees, reliable index products, and good risk tools. But power doesn't care whether you asked for it. When you're the largest shareholder in thousands of companies, when central banks ask you to help design rescue programs, when your software is the default risk engine for the global financial system, you don't just manage money, you shape the world. And critics worry about three main things. First, concentration of power. If three giant firms, BlackRock, Vanguard, and State Street, control huge slices of most major public companies, then competition might suffer. CEOs know that their biggest shareholders are the same across the entire industry. If the same few players are major owners of all the airlines, all the banks, all the tech giants, do those companies really compete as aggressively? Or do they start to look more like a quiet cartel with the same shareholders on top? Economists are still arguing about this, but the concern is simple. When ownership is concentrated, incentives change. Second, conflicts of interest. If BlackRock advises central banks while also running funds that benefit from those decisions, the line between referee and player blurs. In 2020, when the Fed bought corporate bond ETFs as part of its emergency program, BlackRock's own ETFs were among the biggest beneficiaries. BlackRock did agree to certain fee waivers and conditions. Regulators monitored the program, but critics saw a precedent. When there's a big crisis, the government doesn't just bail out banks. It also leans on and potentially boosts the biggest asset manager. Third, systemic risk. What happens if Aladdin gets something wrong? If one bank misprices its risk, that's bad. If a system used by hundreds of banks, pension funds, and asset managers misjudges risk in the same way, that's dangerous. The more people rely on the same models, the same signals, the same ETF flows, the more the system starts to move together. When everything is calm, that's fine. You get efficiency, tight spreads, easy diversification. But in a panic, it can be deadly. If everyone is running similar models, they might all decide to de-risk at once. Sell the same bonds, dump the same stocks, get out of the same markets. That's when passive money becomes very active very fast. So where does AI fit into all of this? BlackRock isn't just a giant pile of mutual funds. It's also a tech company. Aladdin uses complex models, machine learning, and huge data sets to measure risk. BlackRock also invests heavily in AI tools for research, portfolio construction, and even client reporting. And as AI gets more powerful, BlackRock's pitch gets stronger. Let us handle the data. Let us watch every bond, every stock, every market 24/7. Let us stress test your portfolio against thousands of possible futures. For a pension fund in Europe or Asia, that's incredibly attractive. Why build your own expensive system when you can rent BlackRock's? But it also deepens the centralization. In a world where AI is increasingly running the money, whoever owns the AI that runs the money owns the leverage. If BlackRock's models say, move out of this sector, that signal can travel far beyond its own funds because other institutions are using the same tools. If its risk system says, this credit looks safe, that judgment can influence trillions in lending decisions. So what does all of this mean for you? If you're watching this, you're probably not running a sovereign wealth fund. You're not the Fed. You're not Larry Fink. But you are living in a world where your retirement savings probably sit in index funds run by firms like BlackRock. Your government may consult BlackRock on how to regulate markets, design bailouts, or manage its own portfolios. The companies you work for, buy from, or compete with may have BlackRock as a major shareholder. A few practical takeaways. First, know where your money is. If you have a 401k, IRA, or brokerage account, look at the funds you own. Who runs them? BlackRock, Vanguard, State Street, someone else? Understanding that is the first step in understanding who has a say over your financial future. Second, understand the trade-off of cheap investing. Low-cost index funds are one of the best inventions in modern finance. They let ordinary people get diversified exposure to markets without paying huge fees. But the flip side of everyone piling into passive index funds is power concentrating in the hands of a few managers. It doesn't mean you should run away from index funds, but it does mean you should be aware of the system you're plugging into. Third, pay attention when you hear BlackRock's name in the news. When you hear that BlackRock is advising a government on climate policy, or buying a major infrastructure firm, or being hired by a central bank to design a bailout, or launching a new AI-powered investment platform, remember, this isn't just another company press release. It's a clue about how the architecture of money and power is shifting. Let's come back to the big question we started with. Has BlackRock become more powerful than most countries? On one level, no. It can't print its own currency. It can't pass laws. It can't send soldiers anywhere. But on another level, its power is very real. It can decide which companies get long-term, stable capital and which ones struggle. It can influence how trillions of dollars vote on issues like climate, governance, and strategy. It can quietly shape the response to financial crises from inside the truth room, alongside central bankers and finance ministers. And unlike politicians, its executives don't need your vote. They just need your money, which, through your pension, your index funds, your savings plans, many of us have already given them. The real risk isn't that BlackRock is run by cartoon villains in a secret lair. The real risk is that so much of the system now runs through a single point of failure. One firm one platform, one worldview about risk and return. If they keep getting it mostly right, the world keeps humming along. If they ever get it very wrong, the shockwaves will not stop at Wall Street. This is Billionaire Money Stories, where we follow the hidden flows of money, power, and technology that shape your life, long before you feel them in your bank account. If you found this story eye-opening, remember, the next time markets panic, the next time a government announces a rescue package, the next time you see the words global asset manager in a headline, ask yourself a simple question. How far does BlackRock's shadow reach into this? Because once you start looking for it, you'll see it almost